NVIDIA has once again proven to the world that the so-called AI bubble looks weak and meaningless in the face of its real financials. With $68.01 billion in quarterly revenue and a net margin exceeding 60%, achieving this level of profitability while manufacturing physical hardware matching or even surpassing top-tier software companies is nothing short of a miracle in industrial history. But this isn't just about profits. Behind this earnings report, NVIDIA is building an ecosystem so tightly integrated through extreme product iteration speed, sovereign AI expansion, and strategic investments that it leaves competitors with almost no room to breathe. Hey everyone, welcome back to Deep Dive Stock Earnings. If NVIDIA used to just sell chips, today it has evolved into the heart and brain of the global AI industry. We're going to break down how Jensen Huang is using aggressive cycles like Vera Rubin, along with a $30 billion annual sovereign AI market, to transform NVIDIA from a chipmaker into an empire that effectively controls the global compute tax. The dual explosion in revenue and profit forms NVIDIA's strongest financial moat right now. Q4 revenue hit $68.01 billion, up 73% year over year, beating even the most optimistic Wall Street expectations by $2 billion. But what truly shocked financial analysts was profitability. Quarterly net income doubled to $43 billion, maintaining over a 60% net margin in a capital-intensive hardware business, reveals NVIDIA's near-absolute pricing power across the supply chain. Normally, hardware companies see margins compress as they scale, but NVIDIA flipped the logic by locking in developers through CUDA, effectively giving hardware software-like pricing power. Every chip sold carries a massive technical premium. Behind this growth is what you could call a forced allocation of global capital into compute resources. NVIDIA's forward guidance injected serious confidence into the bulls. The company expects next quarter revenue to reach $78 billion, far exceeding market expectations. What's strategically significant is that this forecast completely excludes data center revenue from China due to export restrictions. That one's critical market has effectively dropped to near zero, and yet demand from the rest of the world is strong enough to fully offset that loss. What this tells us is that the AI boom is no longer dependent on any single region. It's a true global resonance. Even under intense geopolitical pressure, NVIDIA can rely on performance gaps to turn global compute shortages into sustained demand. This decentralized growth engine gives NVIDIA incredible resilience and reinforces its irreplaceable role in allocating compute resources. One standout detail in the report is the networking segment. While the overall data center business grew strongly, networking revenue surged 163% to $11 billion. As GPU clusters scale, raw compute is no longer the only bottleneck. Interconnect efficiency becomes critical. NVIDIA's InfiniBand and Spectrum-X technologies ensure its chips operate at peak efficiency within massive systems. NVIDIA isn't just selling engines, it's building the entire logistics system of the factory. By deeply integrating networking into its platform, it blocks competitors from entering through that layer. This GPU plus networking lock-in creates a fully closed ecosystem. The full-stack dominance is the real reason behind its valuation premium. Even as the Blackwell architecture enters mass production, NVIDIA is already showcasing its next-generation Vera Rubin platform. This pace of hardware iteration is unprecedented. Early samples have been delivered to key customers, with promises of up to 10x performance per watt improvements over Blackwell. This relentless cadence keeps competitors permanently behind and forces the market to constantly chase NVIDIA's next move. This annual upgrade cycle is essentially raising the barrier to entry for the entire industry. While competitors are still trying to catch up to Blackwell, NVIDIA has already shifted the battlefield to Rubin. Anyone trying to compete on price, performance, or imitation faces the harsh reality of being outdated the moment they launch. The report highlights a major industry inflection point. AI is shifting from pure model training to inference-driven revenue. Jensen Huang emphasized that the era of agentic AI has arrived. This means AI is no longer just for it's becoming a direct revenue-generating tool. Companies like Meta are already seeing measurable gains in ad performance and conversion rates, proving the ROI of AI deployment. If AI couldn't generate revenue, capital spending would eventually dry up. But now the logic has flipped. If you don't invest in NVIDIA-powered AI, your competitors will outperform you with higher efficiency and lower costs. This shift from arms race to production tool means compute has become a commodity like oil or electricity. A largely overlooked growth driver is sovereign AI. This segment has already reached a $30 billion annual run rate. Countries like Canada, France, and Singapore are treating compute infrastructure as a strategic national asset, building data centers just like energy grids. This opens a massive new growth avenue for NVIDIA beyond traditional cloud providers. We used to worry about hyperscaler capex peaking, but now governments are entering the game and lifting the ceiling again. Compute is becoming a pillar of national power, and no country wants to fall behind. NVIDIA happens to be the primary supplier in this space, creating a long-term, stable profit pool. Behind the record performance, there are trade-offs. Gaming revenue dropped 13% sequentially, not due to weak demand but supply constraints. NVIDIA made a rational decision, prioritize $30,000 AI chips over a few $100 gaming PC. This likely means prolonged shortages in the consumer market. This might disappoint gamers, but from a capital efficiency standpoint, it's the only logical move. As long as AI margins far exceed gaming, this allocation won't change. It also highlights NVIDIA's luxury problem. Demand isn't the issue, capacity is. NVIDIA is also showing unusual confidence in its financial reporting. Starting next quarter, it will no longer exclude stock-based compensation (SBC) from non-GAAP metrics. That means voluntarily absorbing about $1.09 billion in expenses, something most tech companies try to adjust away. This sends a powerful message. NVIDIA's profitability is so strong, it doesn't need accounting tricks. Even with that $1.09 billion expense, its margins remain industry-leading. That kind of transparency builds massive trust with long-term institutional investors. Finally, look at how NVIDIA reinforces its dominance through capital allocation. It invested $17.05 billion into companies like Interpic and CoreWeave. This creates a unique flywheel. NVIDIA funds these companies, and they use the capital to buy NVIDIA chips. It strengthens CUDA's dominance and ensures new data centers are built on NVIDIA's architecture. To sum it up, NVIDIA has built an unprecedented power structure through hardware leadership, full-stack networking, sovereign AI, and capital flywheels. So the real question is, in the face of this near-total compute dominance, who can actually challenge NVIDIA? Drop your thoughts in the comments. This is Deep Dive Stock Earnings, and I'll see you in the next one.